Let us see the next question. Suppose Mr. X in a world where there are only two assets, gold, stocks. He is interested investing his money in one, the other, or both the assets. Consequently, he collects the following data on the returns of the two assets over the last 6 years. For gold, information is given. For stock market, information is given. Average return, that is X bar, is given to us, and standard deviation is given to us. Correlation coefficient between both of them is negative zero point 0.4. Mr. X came to know that GPEC, a cartel of gold producing countries, is going to vary the amount of the gold it produces with the stock prices in the country. GPEC will produce less gold when the stock markets are up and more when it is down. What effect will this have on the portfolio? That you need to explain. I request all of you to go through the question, please. See, friends, over here the question is providing the information that he is considering investing in one, other, or both the assets. So we understand that, say, if at all he is making investment in both, then in that case he will get the advantage of the diversification. Why? Because the correlation coefficient between both of them is negative. That is what we can say, or that is what we can advise it. However, we understand that, say, because of this action, what kind of action? Action is that this gold producing, say, the countries, say, will vary the production of the gold with the stock price. When GPEC will produce less gold when the stock markets are up. So when the stock market is up, at that time you produce less. In that case, what will happen? The price of the gold will again increase. The stock market is also up and the gold price has also gone up. And more when it is down. So when stock market is down, you produce some more amount of the gold, and with that, so the price of the gold will also fall down. So what will happen? That, say, instead of this negative relationship, because of this action, it will become positive relationship. And with the positive relationship, the advantage of the diversification will be lapsed. This is what, say, we understand over here. Over here we are required to answer something like this, that at this point of time, making investment in both of them is definitely going to give advantage in form of reduction of the risk. Why? Because the correlation coefficient is negative. However, if at all, say, this cartel is successful, then in that case the advantage of the diversification will be lapsed, because the price of the gold, that is, so the return of the gold will have positive relationship with the stock market. This is what we understand. So the written answer of the question. Mr. X is advised that if investment is made in gold and stock, comma, then there will be an advantage of diversification due to negative relationship. Full stop. With paragraph right down. However, if GPEC cartel is successful, comma, then price of gold and stock market will move in same direction. Full stop. Further in that write down, if both of them move in same direction, comma, in that case benefit of diversification will be lost. Full stop. Return from gold will increase when stock market increases and vice versa. This is what we understand.